Olá, pessoal. A gente vai entrevistar agora o Howard Marks, fundador da Oaktree Capital Management, que é uma das principais gestoras de investimentos alternativos do mundo. Tem cerca de 150 bilhões de dólares sob gestão. Eu estou aqui com Samuel Consoni, que é gestor dos fundos de fundos da família Selection, da XP, e a gente vai falar com o Howard sobre perspectivas para os investimentos, para a economia mundial e outros assuntos aí que com certeza vão interessar para o investidor brasileiro, né, Samuel?
Isso aí, tudo bom? Obrigado pelo convite, prazer estar aqui contigo fazendo mais essa entrevista. O Howard Marks ele é um dos gestores super importantes aqui dos nossos portfólios internacionais, então vai ser bem interessante aqui ouvir o que ele tem para falar para a gente, dado esse cenário atual aí que não está nada fácil de decifrar.
My first question is about your last memo. So in your last memo, you said you can't predict the future, but you can prepare for different market scenarios. So I'd like to know in which part of the market cycle are we right now and how to prepare for it in terms of asset allocation, in your opinion?
Well, this is a very unusual cycle because, we had some very profound effects last year and into this year, which were non-cyclical. They were exogenous events. You understand the word exogenous? They came from outside. Most cyclical developments are internal to the market. In other words, things go well in the economy, people get optimistic, prices rise, and once they rise too far, then they have to correct. So then they turn down, and then they fall through the fair value till the point where they're too cheap. And then when it's too cheap, they correct and they move back toward full value. So it's all about excesses and corrections, excessively high, excessively low, and then correct back to the mean. This cycle had nothing to do with any of that. These events, it's like almost like a meteor from outer space hit the earth. We had a pandemic. And because of the pandemic, we had to close most of the economies of the world to control it, to reduce social contact. So we had a very serious economic slowdown. And we had a market decline. And then, of course, none of that was normal cyclical behavior. Then, to fix it, the central banks of the world, including the Fed, plus the US Treasury, went out and gave out money. They distributed money, they spent money, they made loans, etc. And the markets responded very favorably. None of that was normal cyclical event. So I'm just giving you this background. We can't really talk about it as how does this compare with other cycles, because this is not really a cycle in the sense of what I've written about in the past. So the interesting thing worth noting is normally the economy and the markets move kind of together, not exactly together. There are leads and lags, but they move in sympathy with each other. So when the economy does well, the stock market does well. Sometimes the stock market anticipates a decline, but when the economy declines, the market does poorly. So they move kind of together. In this case, we hit the high February 19th of 2020, 3386 on the S&P, I think. Then 5 weeks later, we hit the low, March 23rd, 2260 or something like that. So the market was down a third in 5 weeks. But then it started up, and it went up in April and May and June. Now remember that the April, May, June, that quarter was the worst quarter in history for GDP in the US. So we have GDP collapsing down 1/3 at an annualized rate. It wasn't actually down. You have to understand, it wasn't down a third. It was, if you annualize the decline, it would come to a third. But you have the economy collapsing and the stock market booming. And this has continued. So the stock market is more than double where it was at the low in March. The economy is, slightly better. That's very unusual. Now, what does it mean? Well, you could say, I'm worried because the economy hasn't done well, but stocks are already high. Stocks are ahead of themselves. That's the negative way to look at it. The positive way to look at it is, yes, it's true, stocks are high, but there's a lot of economic growth yet to come. And we're just at the beginning of an expansion. And we believe that there won't be a recession for years. And so this is in investing, almost everything can be viewed either with a negative bias or a positive bias. And I've just shown you both of those. But that's where we stand cyclically, if that answers your question, Juliana.
Yeah, sure it does. But how can you prepare for it in terms of asset allocation?
Well, as I indicated in the memo, we don't know what's going to happen with inflation. It may, first of all, we're having inflation. And the question is, will it continue for a long time or will it be short term? Short term, I take to mean a year or so, and long term would be 3 to 6 years. And nobody knows. And anybody who says they know which it's going to be is either deceiving themselves or deceiving you. But but even not knowing, you could say to yourself, you know what? I'm worried about inflation. I don't know if it's coming or if it's going to be permanent long term, but I want to make some preparations. Now, the preparations you'll make are not exactly the same preparations that you would make if it was possible to know exactly whether the inflation will be long term or not, because you don't know. But you make some preparations. So you may own floating rate debt rather than fixed rate debt. You might buy apartments because maybe landlords can pass on rent increases. You might buy the stocks of companies where earnings grow, where they can grow earnings faster than inflation. So have real growth. And I would not advocate a wholesale change of portfolio, sell everything you have and buy a whole new portfolio, because we're not sure and because that kind of transaction is very expensive. But at the margin, you could sell some fixed rate bonds and buy some floating, or you can, sell some bonds and buy some stocks of growing companies and so forth. So, there are things that you can do to prepare for the uncertain future, even though we don't know what it holds.
Great. My question would be exactly about inflation, and you already answered it a little bit. Yesterday, we had a very expected FOMC meeting, and it looks like the Fed is not facing it as a big issue. You said in your last memo that you didn't know whether the inflation would prove transitory or not. You already talked a little bit about it. How many doubts, I don't know if I can ask that way, I put that way, but how many doubts do you guys have about it being transitory or not from July to November, as we speak? What the macroeconomic data tell about the inflation being transitory or not? It's still a very, very hard thing to say, or what?
Let me say one thing, Samuel. It's always hard to see the future. There are two kinds of times: when we think it's easy to see the future and when we think it's hard to see the future. But I would say that when we think it's easy, we're kidding ourselves. It's never easy. And in fact, one of the most dangerous things is when you think it's easy, when you think you're sure you know what the future holds, that's how you can get in trouble, because you make big bets which could be wrong. But anyway, it's hard to know. And, you know, first of all, you know, we have shortages. So cars are in short supply. So car prices are high for new cars, which are hard to get. And because new car prices are high, old car prices go up because that's, you know, they're substitutable. Then we had, when people came out of their isolation and they wanted to buy new houses, obviously not too many houses were built in the last 2 years. So we had a shortage of housing. So everybody starts building houses. When everybody's building houses, then there's a shortage of lumber. So lumber prices go up. And so this is how the economies work. Of course, one of the things we have now is the shortage of labor. And there's a variety of reasons. There are still millions of people out of work, but not for the jobs that want people. So people are changing jobs to get more pay. People who aren't working, businesses are enticing them to come back to work with big raises and bonuses and so forth. So the cost of labor is going up. So all these things in the economy look inflationary. And the question is, will they get fixed? You know, once the supply chain is working positively, and once everybody who's going to come back to work has come back to work, will these things settle down? And it's hard to know. Inflation is in particular very complicated because of the role of inflationary expectations. If people expect that prices will go up, what do? They'll go out and buy now. And if they go out and buy now, what happens? Prices go up.
Self-fulfilling promise.
Self-fulfilling prophecy. That's right. History indicates that once inflationary expectations take hold, it's very hard to reduce them, because this feeling that everything's going to go up in price affects behavior and is self-fulfilling for a while, so people believe it more. And if they believe that there's inflation and act on it, and it produces inflation, then they believe it even more. So, and it's hard, but I mean, there's no measure there's no way to know what's going on with inflationary expectations or whether they'll be permanent. So these are some of the reasons why it's very hard to predict.
Great. Again, talking about your last memo, you said that asset prices seemed reasonable relative to interest rates. Is this your view?
Yes, I think that's right. I think I said in the memo, maybe I didn't, that, look, we have the lowest interest rates in history. And interest rates play a very strong role in setting asset prices. And I've gone through that, but it's very important that people understand how that works. So the higher interest rates are, the less something is worth, all things being equal, and vice versa. So when you have the lowest rates in history, it would make sense that you have the highest prices in history, but it happens we don't. The S&P, the way we gauge the price of the S&P 500, for example, or any stock, is we look at the PE ratio relative to the earnings that are expected in the next 12 months. And that's called forward-looking earnings, as opposed to backward-looking, where you compare the price to the last 12 months of earnings. Now, you can do the latter more precisely because we know what the earnings were for the last 12 months, but it's really the future that matters. So we like to do it on forward earnings, but on the other hand, we don't know precisely what the earnings will be. But nevertheless, the PE ratio based on forward-looking earnings is between 20 and 21 today. The historic average is 16, roughly. So we're high based on PE ratio, but not terribly high, because in 2000, for example, it was 32. So today we're only 21, not so high. The other thing is that the composition of the S&P 500 has changed to include more technology names, and technology names typically carry higher PE ratios. So it shouldn't be surprising that the PE ratio is above the historic average. So when I look at the whole thing, I say high, but not crazy. And of course, the definition of a bubble is crazy. So I don't think we're in a bubble. We're high, but a bubble is an irrational expansion. And I would say that our prices, while high, are rational. That is, they make sense. But they are dependent on low rates. Prices are high because rates are low. And if rates go up, then you would expect that prices would soften. So you might say, but Howard, if prices are going to soften, shouldn't we get out of the market? And the answer is, we're back to saying, I don't know. I don't know if we're going to have inflation, which would cause higher interest rates. And I certainly don't know when. And if we get it, I don't know how long it's going to last. So I think the most important thing that I would stress for your listeners or readers or whoever they're going to be is the most important single thing is to be an investor and invest early, invest as heavily as you can, and keep it that way. You know, the stock market has gone up about more than 9% a year for 90 years. And it may slow down, but it's still going to go up. In the long run, it's going to go up 6, 7, 8, maybe 9%. And you don't want to miss that. That's the bottom line. And if you try to be clever and you get out now because you think it might go down because rates may go up, you might miss something. Some people started talking about bubbles almost a year and a half ago, last summer. And the stock market's up like 35% since then. If you would have gotten out then because you felt clever, you'd have missed 35% appreciation. And it's going to be very hard to make that back. And if you get out today, you might miss something. You may not. We never know. I think that nobody should be in this business and act as if they know what the future is going to bring. But, if you take your money out of the market today, what are you going to do with it? If you in the States, if you put it in the bank, you get 0. If you buy treasuries, you get 1 or 2. So the thing is that money has to be someplace. And if it's not in the market, where are you going to put it? And being in the market today has disadvantages, mostly surrounding inflation and rising rates. But it also has advantages because companies are doing well, the economy is doing well. And, if the companies continue to increase their earnings, then there would be an expectation that the trend for the market would be positive. So you have to offset these various things on one hand, on the other hand. And, where I come down is there's a risk of inflation, there's a risk of rising rates, there's a risk of, and prices are high. That's all true. So those argue for moderation. But it's also true that the economy looks good and there's no better place to put your money. So people should invest for the long term. They should accept the fact that once in a while there will be declines, but they should just strap it on and live with it. You can't avoid it. Nobody's smart enough to get out and back in at the right time. So you just have to live with it. We all do things in our lives because we think they're good that have some negative aspects. We walk down the street because we want to enjoy the outside. Could get COVID, but we make a decision to go outside because it's a net benefit. Same with the stock market. If we buy it and hold it for 30 years, we think we'll make a bunch of money. Could have a bad year once in a while. But remember that the stock market goes up 7 out of 8 years or 9 out of 10 years. It almost always goes up. There are occasional corrections, downward moves, but so it goes up and then it goes down, but then it goes up again. And usually each high is higher than the last high. So if you just hold it and ignore the volatility, the long-term result of being a stock market investor to date has always been good. And I think will continue to be good in the long run. So you should invest for the long run and forget about the short run. Now, that's not so easy because people read the newspaper every day and they say, oh, I went down 1% yesterday. But they have to realize that that doesn't matter in the long run. And they can't respond to that. You know, if you could invest, I'm confident that in the next 30 years, the stock market will make, let's say, this is not a prediction, but at least 7% a year. And the way things work, the way the math works, if something makes 7% a year, grows 7% a year, then it doubles every 10 years. So that means that if you invest $1 today, or a haish, and for 30 years, that means it'll double after 10, double again after 20, double again after 30. So if you put in $1 today, it'll be 2 in 10 years, 4 in 20 years, 8 in 30 years, maybe 40 years, then you have 16. So if you're 30 years old, Samuel, by the time you're 70, if it goes that way, which I think is a reasonable expectation, for every dollar you put in today, you'll have $16. Well, that's damn good. And you know, if you can put in $150,000 today, then in 40 years you'll be a millionaire. Actually, you know, you only have to put in $60,000 to be a millionaire in 40 years. So what does that mean? Put the money in, leave it in, and just don't mess it up. And you know, you can try to be clever around the edges. You can buy this and sell that. You can get a little in and a little out and all that stuff. But maybe you can enhance the results. Maybe you can't. But the most important thing is don't ruin this process of compounding. You know, people have said, who was it? Einstein maybe said that you know, that the magic of compounding is one of the great miracles in the world.
Great. Howard, apparently the major central banks learned how to fight recessions by printing a massive amount of money and buying huge volumes of credit whenever a crisis threatens to break out.
Yeah.
Using your own words from a recent interview I watched last week, will they know when to take their hands off the economy and let it run itself? What are the risks if they fail to do so?
Well, number one, most people who are investors believe in the free enterprise system, the free market system. And what that system says is that the free market is the best allocator of resources. But if the Fed never takes its hands off, that means it's always managing the economy and the markets. That means we don't have free markets in money. And, you know, most people would say that over the last, well, I'm going to roughly say 7 years, that money has been too cheap. And you see, every time a government makes a decision, we have to start with this. Governments don't make anything. It's not like a business that makes cars or dresses or tires or computers. Governments don't make anything. All they do is they collect money and they give it out. They collect money and they spend it. So it's in other words, it's a net zero game. The only question that matters is, who do they collect it from and who do they give it to? In other words, who wins and who loses? Who gets subsidized, who gets penalized? So think of the last 7 or 8 years, 7 years, as I said, rates have been unusually low. I think they've been lower than they should have been. who gets subsidized? Borrowers, people who want to lever up their portfolios and take more risk. And so homeowners have been subsidized with cheap mortgages and so forth. Who gets penalized? Savers, investors, lenders, retirees. You know, if interest rates are reduced, then if you have a fixed income portfolio, then your rate of return goes down. So you're being penalized. And I think that the decision has been too much in the favor of borrowers. And among other things, that encourages risky behavior, because people say, look, I can borrow at 1%. And if the thing I buy doubles, I could make 100% on my own money. But if I use some leverage, I could make 200% or 300%. And leverage is so cheap. So low interest rates encourage borrowing and risky behavior and leverage. And I think if the money market itself sets the interest rates free of government intervention, I think interest rates will be a little higher, and risky behavior would be somewhat discouraged. You know, investors, markets are safe and sane when investors are motivated by a combination of fear and greed. When they want to do things and make money, but they don't want to do too much and lose money. The investor is afraid that if he doesn't invest, he'll miss, but he's also afraid that if he invests, he could lose. And having a healthy balance between fear and greed and optimism and pessimism is healthy for the markets. But, you know, the Fed, through its behavior, through its money printing, lowering of interest rates, bond buying, et cetera, has created a market where there's a lot of fear of missing out, FOMO, and not much fear of losing money. And that's not the healthiest thing in the world. So that's a reason why we have to be careful. But when you put it all together, I come out in a place which is kind of my normal place in terms of risk taking. The media, in particular, try to get people like me to say buy or sell, in or out, risk on, risk off. And when you think in a binary terms, either buy or sell, it's not realistic, because what you're saying is, all right, here's the intrinsic value of a stock. It's 100. If it gets above that, it's a sale. If it's below that, it's a buy. If it gets to 101, it's a sale. At 99, it's a buy. Too precise. And anyway, it produces hyperactivity, too much buying and selling. What I'd rather say is, rather than two zones, buy and sell, we have three zones: rich, fair, cheap. So once in a while, things get so crazy high that you must sell them. And, you know, I would say that 2000 was like that, and 2007 were like that. And once in a while, things get so cheap that you must buy aggressively. Forget all defensiveness, forget all care, and just buy aggressively. And 2001 was an example of that, and 2002 for our credit markets, and also 2000 and late 08, 09 was like that. But so when the market is irrationally high, you should emphasize more defense. When it's irrationally low, you should emphasize more offense. But in the middle, the fair zone, you should balance offense and defense. And that's what I would argue for today. Normal, not, you know, and if you're worried about inflation in the short run, you might emphasize defense. But if you emphasize defense for the short run, you run the risk of missing out on the long-term benefits of compounding. So so one of the main things I would do with your audience is I would discourage hyperactivity. There was an old saying, don't just sit there, do something. But in the investment business, for most people, most of the time, I would say, don't just do something, sit there.
Great. Howard, do you still have time for 2 more questions?
2, yes.
Oh, great. So let's talk a little bit more the crypto market, understand a little bit more about this market during the pandemic, because you spent time with your son, Andrew. So I'd like to know what's your view on that market, what you learned from that experience as well.
Well, look, Andrew convinced me that my first very negative reaction in 2017, right or wrong, I didn't have enough information to base an opinion on. And he's right about that. I gave a I've been doing this a long time, and I have been very successful being skeptical of financial innovation, because most financial innovations, they say how they're supposed to work, but they're not tested until bad times come along. Buffett says it's only when the tide goes out that we find out who's been swimming naked. So these things are tested in bad times, and most of them have failed. So I had a knee-jerk skeptical reaction to cryptocurrencies in 2017, and Andrew convinced me correctly that I really didn't have the facts. I was going on impression. So I've tried to learn more and talk to people who are pro-Bitcoin and understand all points of view. And there's a case. Now, part of this is generational, because I think it's when you've been around as long as I have, if something really new comes along that changes the world, at the beginning, it's hard for the old generation to get it. So, most of the people who are in favor of crypto are half my age. That doesn't make them right. Also doesn't make them wrong. But I do think that there is an age divide, that it's very hard for old timers to grasp the new thing. And what Andrew explained to me is that, number one, there's a supply demand case, because in Bitcoin, for example, the software limits the creation of tokens to 21.5 million, but the demand might rise very strongly. And if that happens, the price can rise. For example, Bitcoin fans tout it as virtual gold, digital gold. It's kind of like gold in terms of holding value in an inflationary environment or in a weakness. But it's better because you don't have to pay to store it, and it's easy to send, and it's easy to exchange and to spend. So they say Bitcoin is like gold, but better. So if half the gold holders in the world want to shift to Bitcoin instead, there'll be a lot of demand, not too much supply. That means prices will go up. So that's the supply demand case. Then there's what I call the use case, because for a lot of tokens, there are actual uses. And in many cases, there are, he calls them tokenized apps. These are apps. These are just like on your phone. These are things, pieces of software you can use to accomplish things, but you need tokens to do it. So Ethereum, for example, is an app, but to use it, you need a token. And as the demand for the app grows, the demand for tokens has to grow. Makes sense? And one of my good friends, who's a very senior guy in Silicon Valley in the VC industry, says that he thinks that crypto is the new thing, and that it's where the internet was in 1985. I don't know if it's true or not. I'm not, and by the way, I know he got his information from somebody he highly respects, who's about the same age as my son. So the old guys get their information from the young guys. But that's the way it has to be in a world of constant change. So, look, a year and a half ago, Bitcoin was about 6,000, and today it's 62,000. So it's up more than 10 times. So either there's something there, or the world's completely crazy. And Andrew says, look, Bitcoin's been around for 13 years. So for it to have lasted 13 years, there must be something to it. So he's managing for money for me, and I'm very happy with that.
Mm-hmm.
Great. Good. Howard, to close our conversation here, where do you see the best opportunities in the market at current price levels as abroad? And also, where would you avoid putting your money at current price levels?
I think it's important to bear in mind that the thing that's wrong with today's market, the negatives, are universal. It's the low interest rates and the risk-prone attitudes. And these things are across the board. These are not related to one market or one sector or one industry. These are across the board. And so everything is high today. And the same phenomena have that impact on everything. So there's almost nothing. You remember what I said, rich, fair, cheap? There's virtually nothing today that's cheap. Most things are priced full or high. And the only goal is to find the things that are less high. But you're not going to find any real bargains. But I still think it's important to invest, because you don't want to put your money in the bank at zero. So some of the things that are, look, and so let's put a pin in that, as they say. Now, where normally, how do you make the most money as an investor? And the answer is, you do the things that other people don't want to do. The things that everybody knows about, understands, likes, feels good about, and wants to do, there's no reason to think you'll be able to get those things at a bargain price. So the things that people are less eager to do today are, I mentioned earlier, structured credit, like CLOs and things like that. These things are complex, and they're not as easy to buy as stocks and so forth. So we think that you can make a superior risk-adjusted return by investing in structured credit. That's one example. Another example may be China. China's been hit, and because of their problems, especially with the builders right now. But if you're a long-term investor, and if you believe in the future of China as the world's second largest economy, and some people say it's going to become the largest economy, you might want to invest in China while it's out of favor and unpopular. I mean, you look at real estate. You see, when I started in this business 50 years ago, I and most people thought that the key to successful investing was buying good assets. But the truth is, it matters not only what you buy, but maybe even more what you pay. So a very good asset bought at a crazy high price is not a good investment. A poor asset bought at a price which is very low may be a great investment. So it's not what you buy, it's what you pay. What can you buy today at a bargain? Well, if you just look at the real estate sector, everybody wants to own data centers and distribution centers for online commerce. So the outlook for those things is great, but guess what? Everybody knows the outlook is great, so the prices are high. So these great assets may not be great investments. On the other hand, let's say New York office buildings. right now they're not too full because not too many people want to come back to work with the disease and so forth. And so everybody knows that, so the outlook for New York office buildings may be uncertain, maybe poor, maybe negative. But guess what? Everybody knows it's negative. So maybe the price is low. Or if people are fleeing from those assets, maybe the price is too low. So, you know, you have to look today for things that people are not eagerly pursuing. You know, office buildings in New York are one example. Structured credit is an example. You know, stocks of companies whose businesses have been affected are an example. But, you know, these are difficult decisions. It's easy to say, what's a great company? It's hard to say it's a great company, but is the price so high that it's a poor investment? And that's why investment really is best left to the experts. And most people should trust the experts to do it for them. And that's why most people today are investing in funds or ETFs or something like that. And I think for most people, it's the right thing. Let's remember, Juliana, that we don't do our own legal work. We go to a lawyer. We don't do our medical work. We go to a doctor. We don't do our dental work. We don't fix our own teeth. We go to a dentist. We don't even fix our own cars anymore because you need a computer expertise. So why should we do our own investing work, the layman? And the truth is the layman should decide on a long-term course of investment, as I mentioned before, stick to it, and put the implementation in the hands of the experts.
Great. It was a great interview. Thank you so much again. It was
my pleasure.
I'm really happy with this interview. I think our readers will be too.
Thank you, Howard.
Okay.
Nice to meet you. Bye-bye.
Well, bye-bye.
Bye-bye.
Bye, Juliana.